Good day everyone, my name is Cherry Ann Elamera and I am going to discuss about bank capital adequacy. So what is bank capital? So bank capital represent the financial cushion that a bank has to absorb potential losses. It's the difference between a bank's asset and its liabilities. It acts as a safety net, protecting depositors and creditors from financial distress in the event of unexpected losses. Bank capital is essentially a financial safety net for banks. The differences between a bank's assets, what it owns, and its liabilities, what it owes. This cushion helps protect depositors and creditors from potential losses, such as bad loans or economic downturns. Think of it as a rainy day fund or banks, ensuring their stability and ability to meet their financial obligations. The importance of bank capital. The first is stability and trust. Adequate capital instills confidence among depositors and investors, enhancing stability. Second, financial resilience. Capital acts as a buffer against unexpected losses, protecting against economic shocks. The third, lending capacity. Banks with sufficient capital can lend more money to businesses and individuals, stimulating economic growth. So this means that they ensure they can weather financial storms and continue operating smoothly. When a bank has sufficient capital, it instills confidence in depositors and investors, protects against unexpected losses, and enables it to lend more money to businesses and individuals, stimulating economic growth. For the regulatory requirements for bank capital. Minimum capital requirements. Regulatory bodies mandate minimum capital levels to ensure financial stability. The next is capital ratios. These ratios measures the proportion of capital relative to a bank's asset, indicating its resilience. The last one is the supervisory oversight. Regulators monitor bank capital levels to ensure compliance and identify potential risk. Regulators play a crucial role in ensuring the stability of the banking system by imposing various requirements on bank capital. These requirements include setting minimum capital levels that banks must maintain and monitoring capital ratios to assess a bank's financial health. By implementing these measures, regulators aim to protect depositors, creditors, and the overall economy from potential risks and failures. Banks have two main categories of capital. So the first capital is Tier 1 capital. This includes common stock, retained earnings, and non-cumulative perpetual preferred stock, so it represents the core capital of banks. The second, Tier 2 capital, comprises some supplementary capital, including subordinated debt and other instruments. It's less liquid and has higher risk compared to Tier 1. So the Tier 1 capital is considered the core capital and includes items like common stock, retained earnings, and non-cumulative perpetual preferred stock. It's the most stable and reliable source of capital for a bank. The Tier 2 capital is supplementary capital, includes subordinate debt and other instruments. While it provides additional financial cushion, it's less stable and reliable than Tier 1 capital. Risk-weighted assets and capital ratios. Risk-weighted assets. Banks are required to hold capital proportionate to the risk associated with their assets. Capital ratios. Common capital ratios include Tier 1 capital ratio or CET1 and the total capital ratio T1. These ratios reflect the percentage of capital held against risk-weighted assets. So banks are required to hold a certain amount of capital proportionate to the riskiness of their assets. This means that riskier assets like loans to less creditworthy borrowers require banks to hold more capital as a caution against potential losses. Capital ratios, such as the Tier 1 capital ratio and the total capital ratio, measure the percentage of bank's capital relative to its risk-weighted assets. So these ratios help assess a bank's financial strength and its ability to withstand economic shocks. For the Basel Accords on bank capital, the Basel Accords are a set of international regulatory frameworks that aim to improve the financial stability of the global banking system. The second, Basel I on 1988, introduced the concept of risk-weighted assets and capital ratios. The third is Basel II, 2004, refined the framework by incorporating operational risk and incorporating internal ratings. Basel III, 2010, strengthened capital requirements, introduced liquidity rules, and increased the counter-cyclical buffer. The Basel Accords are a series of international banking regulations designed to strengthen the global financial system. For the Basel I introduced the concept of risk-weighted assets and capital ratios, requiring banks to hold a certain amount of capital based on the riskiness of their assets. Basel II refined this framework by incorporating operational risk and allowing banks to use their own internal risk models. Basel III, the latest version, further strengthened capital requirements, introduced liquidity rules, and implemented a counter-cyclical capital buffer to build up capital during economic booms and release it during downturns. These regulations aim to ensure that banks have sufficient capital to withstand financial shocks and maintain stability. Stress testing and capital adequacy. The first, stress test. Regulators conduct stress tests to evaluate a bank's capital adequacy under the adverse economic condition. The second, scenario analysis. Stress tests involve stimulating severe economic shocks to assess a bank's ability to absorb losses and maintain capital requirements. The third, capital buffer. The result of stress tests inform banks' capital planning, enabling them to build an adequate capital buffer to withstand potential crises. Stress testing is a crucial tool used to assess a bank's financial resilience. Regulators conduct stress tests by simulating severe economic shocks to evaluate a bank's ability to withstand adverse conditions and maintain adequate capital levels. The result of these tests help banks identify potential vulnerabilities and take steps to strengthen their capital positions. By building a sufficient capital buffers, banks can better protect themselves from future crises. Challenges in maintaining adequate capital. The first, economic downturns. Recessions and market volatility can lead to increased loan losses and reduced capital. The second, regulatory changes. Evolving regulations can increase capital requirements and impacts a bank's profitability. The third is competition. Competition among banks can put pressure on profitability, making it challenging to maintain sufficient capital. Fourth, technological disruption. Emerging technologies can introduce new risks and necessitate investments in capital. Banks face several challenges in maintaining adequate capital. Economic downturns can lead to increased loan losses and reduced profits, making it difficult to build up capital. Regulatory changes often impose stricter capital requirements, impacting a bank's profitability. Competition among banks can pressure profitability, making it harder to maintain sufficient capital. Finally, technology's disruption can introduce new risks and require significant investments, further straining a bank's capital resources. Lastly, trends in bank capital requirements. The first is higher capital requirements. Global regulators are continuing to increase the capital requirements to enhance financial stability. The second focused on systemic risk. There's growing emphasis on regulating large systematically important banks to prevent financial contagion. The third is digitalization and innovation. Regulators are adopting capital frameworks to address the evolving risks associated with digital banking and fintech. Bank capital requirements are evolving to address the changing landscape of the financial industry. For the global regulators are continuously increasing capital requirements to strengthen the financial system and prevent future crises. There's a particularly focused on regulating large systemically important banks to mitigate systemic risk. Additionally, regulators are adopting capital frameworks to account for the emerging risks and associated with digital banking and fintech innovations. These trends aim to ensure the stability and resilience of the bank sector in the face of evolving challenges. That's all. Thank you.